An effective audit begins with a good plan. Every audit begins when the auditor identifies what they need to do to gather sufficient appropriate audit evidence. The plan will change over the course of the audit, but certain decisions need to be made early on. How will they staff the audit? When will they time the work? How will they adapt to the changes they expect to see? And so the auditor begins by asking certain questions. For example, what is their responsibility? What is management's responsibility? Well, this topic has been more broadly discussed in prior chapters. We'll begin to see it go into more detail as we deal with specific planning issues. For example, auditing estimates represents a unique challenge that the standards have identified. What is the auditor's responsibility for these complex accounting events? What is management's responsibility? How will the auditor document they've satisfied their responsibilities? We're going to go into more detail on that later on. Another planning issue that will come up is, will we use specialists? Specialists are outsiders of the firm or people within the firm who have unique special skills that we can rely on to address unique issues. It might be an IT specialist, it might be a valuation specialist. They're brought in and under very unique circumstances because they possess knowledge the auditor does not have, which raises a big issue in the audit. Not all the time the auditor's going to have all the knowledge. They're going to need to bring in specialists to help them. One document for you to review is the engagement letter. This is contained in the auditing standards, and I have provided an example on Canvas. The engagement letter is a great document to review because it documents what the auditor expects to do. What are their responsibilities? How will it work out? So it really is revealing as much as possible the public nature of their audit plan. So please take time to review that, highlight the important concepts, and identify where you think an audit problem could occur. Present fairly. The auditor must design a plan that will allow them to gather sufficient appropriate evidence to determine whether the financial statements are presented fairly. And so by present fairly, we mean in GAAP compliance. In particular, the auditor is going to design their audit around the assertions. So let's recall some things we know about the assertions. One, assertions are not a one-to-one process. When we think about assertions, we're not going to think about, I'm going to do one procedure to gather evidence about one assertion. It's entirely possible that we will have one procedure that will speak to multiple assertions. It's also possible we might need to conduct several procedures to gather sufficient appropriate evidence to satisfy one assertion. So for example, we may start with inquiry and then have to do a follow-up inspection of documents. Another thing we need to remember is that assertions don't exist independent of accounts. So we would never say we're testing for completeness. We'll be testing for the completeness of accounts receivable. And so always link them. Another thing is they are variable importance. Some assertions are very important for some accounts, while not important for other accounts. For example, while I'm very concerned about the completeness of accounts receivable, I would be less concerned about the completeness of revenue. The reason is the risk. I can imagine many scenarios where management might want to omit a liability, but it's not common that they would want to omit revenue. And there are going to be some special items I'm going to want to pay attention to. So for example, leases, consignment inventory that have unique important assertions, valuation, rights and obligations will be more important for those, where typically we would not say those are high priority assertions. So what are the assertions? Well, we broadly categorize them in the private company standards as those that relate to transactions, those that relate to account balances, and presentation and disclosure. If we want to think about what questions they ask, transactions are going to try and ask the question, what happened this period? These accounts are most commonly linked to the income statement. Account balances are the ones that most closely relate to the balance sheet. Where are we at? Where is the company at? Remember the pronouns. Where is the company or the client at fiscal year end? A presentation disclosure is, are the necessary notes provided in a readable way so that investors can correctly understand? So for example, if it's a contingent liability, are adequate disclosures made so that the investor can understand the potential loss associated with it? So we'll talk about that later on. So what are these assertions? Completeness essentially is saying, do the accounting records contain everything they should? And so we'll start with information in the real world and verify that everything in the real world made it into the accounting records. We'll see a parallel existence is going to say everything in the accounting records made it into the real world. And so what I mean by that is, if I started with an invoice, is there going to be evidence something happened in the real world? If an invoice is not supported by real world events, then it should not be in the accounting records. The cutoff assertion is always violated, requires you to violate completeness or existence, because as the scenario details here, between the fiscal year, you must include everything. Anything outside of that fiscal year, you would not include. So if we were to take an event that happened after fiscal year end and include it, we could say it did not exist in the fiscal year. If we take something that should have been included and delay recognizing it, then we have violated the completeness assertion. The reason why we include the cutoff assertion is because we want to draw particular attention to the risk associated with timing of transactions. So it not only needs to be recorded, it needs to be recorded in the correct period. And so this will actually influence our testing, as we'll probably do additional testing around the transactions right around fiscal year end with certain accounts, in particular revenue and inventory. Valuation and allocation relates to, is there a correct mapping between the economic value of something and the accounting valuation? Sometimes this is really objectively easy. For example, if you have an invoice, is that exact economic number, you bought a piece of machinery for $10,000, is $10,000 number listed in the purchases account? However, what's the depreciation becomes more of a subjective matter. Is it over depreciated? Is it under depreciated? Is it misleading? So there's going to be a lot of issues. You'll see this also with allowance for doubtful debts, inventory valuation, all kinds of things, especially when they get to more complex calculations. Rights and obligations does the economic ownership match the accounting ownership? And so we'll see that sometimes where a company may not economically own something, but they may assert it for accounting purposes. Think leases, consignment, inventory. Presentation and disclosure, those are all those notes. Does the economic reality accurately reflect the accounting classification? So if we classify something as a short-term liability, is it truly a short-term liability, or would it be more accurately labeled as a long-term liability? And so as you move on and start to practice these assertions, it's going to take a while. Methodical is the key. Don't try and answer questions all at once. Take your time, be patient, and you'll get this.